Hi, and welcome to the Choose FI Foundation's Educational Speaker Series, where we take topics from the Choose FI Foundation's pre-K through 12 financial literacy curriculum and break it down with expert speakers in the area to bring a little bit more information and ideas to the topic. Hope you enjoy it.
Hi, I'm Rob Phelan, and I'm here with Gabe Fortmann. We are going to talk about mortgages. So we've talked a lot about credit scores, different types of loans, but we're going to focus specifically on mortgages today. Gabe, how you doing?
I'm good. How about you guys?
We're
Well,
doing
how
good.
about
We're
you,
doing
Rob?
good. Yeah, just me at the moment, but
Yeah.
hopefully we'll be an audience later. So Gabe, tell us a little bit about yourself. What do you do?
I am a loan officer, specifically a producing sales manager for Embrace Home Loans, and I've been doing this for over 15 years. I've come into your class the last couple years and given an in-person, but we couldn't make it this year, and COVID gave us the ability to do it over Zoom.
Yeah, doing the best we can. Love this technology stuff. Okay, so let's start there. How is COVID affecting this whole mortgage business? What's it doing?
I mean, that is a 45-minute education in itself, but the very basis,
Yeah.
it's affecting all the economics. So when the stock market is way down, then that means interest rates are way down, which means everybody wants to refinance, but they can't refinance because they're now losing their jobs and they are claiming forbearance because they can't make payments on their current mortgage. So then we can't do a refinance. And then it also has to do with all of the mortgage people that do mortgages, myself, Wells, Bank of America, you name it. They have to control that because they can only do so many mortgages at any one time. So like last month, where we normally do 300 million in mortgages, we did 475 million in mortgages, and we're on pace for even more this month. And you've got to be able to handle that kind of pipeline. Do you have enough appraisers? Do you have well, not appraisers, but do you have enough processors, underwriters, and all the other people that can filter it through? And there's bottlenecks all over the place. So
You're not slowing down, basically, is what you're saying.
I am not slowing down. I am not slowing down. It's been very busy for me, but it has presented a lot of challenges as well. Like Bank of America, Wells Fargo. Some of these are escaping me, but they're not doing anything right now.
Mm-hmm.
So there's a lot of risk, where we used to be at 580 credit score for an FHA loan, which is Federal Housing Administration. We're now at 640, and there's a lot of mortgage people out there that are at 680. And we'll probably talk about this in the conversation.
Yeah, don't worry if that's not making sense right now, guys. You will get that very soon.
Yeah, I'm probably just running. I run away like a freight train because I just know it all too well. But we can come back to that. But it's affecting us a lot. It's very stressful.
Yeah, and it was just there was one really interesting point you said there where you said interest rates are falling. Like if you had the ability to get a mortgage, this would be a great time to do it because it's going to be one of the cheapest it's ever been.
Yep.
But if your personal finances are not in order, you don't have an emergency fund, you didn't have a stable income or multiple sources of income, you've basically put yourself in a position where you can't make a move. And a lot of people are seeing that with the stock market too, like stocks falling to really attractive prices maybe. And people don't have money on the sideline to put in because now suddenly I need to use that because I didn't have an emergency fund or whatever it was. So yeah, we're seeing the value in personal finance, and the people who are going to profit the most out of this are the ones who had cash on the sidelines. They had a very healthy emergency fund, and they were able to say, okay, you know what, I can put money into the market or into buying a house right now when it's a really attractive time to do so.
All right, so. That's why they say you got to have money to make money.
It's like one of those ones where myth in some cases, not myth in other cases, for sure.
That's right. You buy on the dips.
Yes. Okay, so Gabe, you kind of mentioned a couple of big banks. You mentioned yourself. What's the difference between like Embrace Home Loans and going to a Wells Fargo to get a mortgage? So a mortgage, guys, is just a loan that is specifically for buying a property, correct?
Yep. So residential mortgage lender is what we are. And the big difference is that that's all we do is mortgages. So we do investment mortgages, we do second homes, but we primarily do primary residences. People are going to live in these homes. And we're limited. We can't do commercial. We can only do up to 4-unit investments.
Okay, so commercial being it's for the purpose of a business, right?
Correct.
And
Yeah,
four
commercial.
unit, you're talking about a building that would have more than 4 separate living quarters within it, right? So anything bigger than that, you're talking almost like an apartment building sort of thing.
Got to be a commercial. Yep.
Got
it. Thanks for bringing it down.
I'm just going to stop you anytime we're like, okay, what does that mean?
Right. Yeah, because there's a lot. So all we do are mortgages, whereas big banks do mortgages and they do deposits, they do IRAs, they do all these other things, and we only focus on doing mortgages. Now, a lot of times, correspondent lenders such as myself don't also service mortgages, but we do service a lot of our mortgages. Service means that when the loan closes and you now have to make your mortgage payments, who are you making them to? If you're with Wells or Bank of America, you're making payments to them most of the time. But we also service our own. So you would stay with us, and that allows us to keep you in our grasp, so to speak, and our marketing efforts. So.
Yeah. Whereas like for me, when I got my mortgage, I think the day after we closed, it was sold to another company, and it's actually been sold again since. So right. I've been making mortgage payments to 3 different companies since I got my mortgage 3 years ago. So yep. Yeah, mortgages can be bought and sold between different lenders.
Yeah, and to blow your mind, every mortgage is bought and sold, every single one. But that gets to the secondary level of where money comes from and all that. But we are a direct lender with Fannie Mae, Freddie Mac, FHA, VA, and that's really a lot. That's beyond basic.
So
we'll just be there.
I mean, who are these people? Who's Fannie Mae and Freddie Mac?
Yep.
What are those?
So first, you got to understand the difference between what is a government loan and what is a conventional conforming loan, and that is who insures the loan. So a conventional loan is through Fannie Mae or Freddie Mac, and they are quasi-governmental agencies. They're propped up or supported by the government, although less and less. Eventually, they're going to be on their own again. But they're called conventional. So they have less restrictions for for requirements, but they also have more risk-based requirements. So for instance, a credit score, and your credit scores can range from 350 to 850, and 850 is the best. And the lowest possible credit score where you can get a loan is 580. And that's not through conventional means, but we're just saying 580. And as I said a little while ago, it's actually 640 right now. So
is that like an unofficial, like this is the standard, or is there like some sort of regulation in place saying you cannot give a mortgage to somebody?
So they're called guidelines,
okay.
Right? There's guidelines in place by Fannie, Freddie, FHA, VA, and then each bank or company will put overlays on top of that. So FHA or conventional might say, yeah, we allow mortgages down to 620, and then Embrace Home Loans could say, well, that's true, but for now we are only allowing 640 and above, right? That's called an overlay.
Yeah.
So when you're looking at the difference between conventional and government, who is insuring the loan, and most of the time, so you got conventional, Fannie Mae, Freddie Mac, right? Those are the two competing conventional conforming loan limits. And then you have FHA, USDA, VA are the government insured loans, right? And when you talk about insurance, you're talking about mortgage insurance. So any loan that is over 80% loan to value, very simple. You have a $100,000 house. If you're financing more than $80,000, then you have to have mortgage insurance. If you're going conventional, then it's more risk-based. So if you have an 800 credit score, you're going to get better mortgage insurance than if you go through FHA with a 800 credit score, because FHA is for everyone, right? Everyone gets the same. If you qualify for FHA, then it's supposed to spread it out and be more of the government is insuring it, so it has to offer it to more people. Same with USDA, same with VA, except VA, I keep shortening it up. VA stands for Veterans Affairs, and that is you have to have served in the military to even look at that loan program, right, to be considered for that. FHA is Federal Housing Administration, and there's no disqualifications for it. It's not a first-time homebuyer program. It's low down payment, and the mortgage insurance is set up for everybody to be able to take advantage of it, right? So it's not super low, but it's not super high. It's right in the middle. So then you would go and look at conventional if you have a really high credit score, right? And then that way you're kind of picking the best of all the worlds.
Yeah,
USDA is a little bit more stringent, but go ahead.
Okay, so I'm looking to buy a house and I walk into a lender, so a mortgage provider. And one of the first choices that we're going to make is what type of loan we're going to get. So are we going to get a conventional loan? Are we going to get an FHA loan, a VA loan, or you said a USDA one as well, which I didn't realize there was a USDA one. I thought there was only three categories. So I have never served. So the VA loan would immediately be out for me. So I'm left with this choice of FHA or conventional loan. And the FHA loan is sponsored by the federal government. So if it's not paid, they will insure it and make sure it gets paid to the lender, correct?
Correct.
So this mortgage insurance sounds awesome. It's like, oh, sweet insurance. If I don't pay my mortgage, someone will pay it for me. This is fantastic. Not the case, right? So what is this private mortgage insurance stuff?
Okay. So in mortgage insurance, let's just call it that for now.
Okay.
There's PMI, which is private mortgage insurance. There's MIP, which is mortgage insurance premium. And then for USDA, it's called a guarantee fee. And the way it works is it protects the bank. It's insurance for the bank. So if you default on that loan, then they're going to help the bank with their losses. The bank is still going to come after you for everything. Mm-hmm. So they call it mortgage insurance, but it's not insurance for you. If you want insurance to help you out or your family out, then you call the person that gives you life insurance or disability insurance. Those are the ones that you want to look at to help you there. So PMI, private mortgage insurance. And the reason that they call it different things is because there's laws out there that say if you have mortgage insurance, when you hit 80% loan to value, mortgage insurance can be removed, right, from your loan. So if you buy a $100,000 house and you finance $85,000 and you have private mortgage insurance, when that gets down to $80,000 that you owe, then you can ask to have it removed. By law, when you get to 78%, then it must be removed. Must be removed, period. And that's PMI, private mortgage insurance. FHA is called mortgage insurance premium, not called private mortgage insurance. So therefore, it's on there for the life of the loan. Mm-hmm. USDA is called a guarantee fee, not a mortgage insurance program. So it's on there for the life of the loan as well. So these are things that you got to think of when determining what loan's going to work best for you.
Okay.
So go ahead.
I was going to say, that's really where I want to go next. So what loan is going to work best for us? So you said, I think if you have a high credit score, you're probably looking at something like a conventional loan. But there was also the question of down payment. So this is the amount of money you are going to bring in and pay for the house, and then you're going to borrow the rest of it to cover the purchase price of the home.
Yeah, sure.
So if, like, say I'm coming out of high school and I'm like, for some reason, I really want to buy a house. I don't really recommend it right out of high school, but say, I'm really dead set on this and I got no down payment and credit score is like just kind of hitting above that 640 mark that you're talking about being the minimum right now. Could I get a conventional loan even then?
Probably not. You probably could not buy a house straight out of high school because one of the requirements is employment history, and you got to have a 2-year employment history. Now, there are ways that you can get around that. I mean, it's not get around it, but there's ways for that to be met. So if you're 16 and you're working at Sheetz and you filed taxes, most of the time you don't because you still fall under your parents. But say you file taxes and so 16, 17, 18, there is a chance you might be able to buy a house because of employment history. But the least that you're going to be able to do with a 640 credit score that's not going to put you in a bad position is probably going to be FHA. So then you're going to be looking at, you need 3.5% down. So let's have the conversation. Down payment, closing cost. All of it's due at settlement, right? But they're two different
settlement's the very end, right?
Settlement's the very end.
Okay.
So you come to me, I give you a pre-approval for $100,000. You go find a house with your real estate agent, and I know lots of them. You go find a house with a real estate agent, you put an offer in on that house, the seller agrees to that offer, and then and then everybody comes back to me and we get the mortgage going, right? So now we're going through the process and we get it all approved and we get the appraisal and everything, and then you go to settlement, and that is the end. Okay. That's when you sign your final papers and the house is yours. As soon as settlement is over, the house is yours. You can do with it what you want.
Okay. What are we talking here for, like, closing costs? Like $100, 200? Like,
you're usually talking, it depends. If you're a first-time home buyer, and it's all, closing costs are usually pretty fixed in some regards and their percentages in others. So for instance, we charge a underwriting fee, and it's the same whether you buy a $50,000 trailer or a $400,000 single family home. You get charged the same. So the percentage is going to be much higher for that low end home than for the higher end. But typically you're looking at right around 4%, right? Okay. So let's just say, for ease of math, you need 4% for closing costs. That's transfer taxes. All these things are conversations you need to have. Yeah. But let's just say you have fees. You have lender fees, you have title fees, you have realtor fees, you have state fees, you have county fees, you have inspection fees. So all of that stuff gets lumped in and is called closing costs, right? Closing costs gets broken down into two categories: prepaids and closing costs. Fees is what I call them, but closing costs. But all in all, closing costs, right? And then you have your down payment. USDA is 100% financing, so there is no down payment. All we have to focus on is closing costs. Okay. FHA is 3.5% down, so now you have your 3.5% down and your closing costs together for all the cash you need to bring to settlement. It's a lot in a very short conversation, because a lot of times we can make most of that stuff go away. We can add first-time homebuyer programs from the state. We can add seller assistance for closing costs. So there's a lot to talk about. Yeah, so there's a lot of flexibility in this. This is why you go to a mortgage loan officer and you say, okay, we're going to try and find a plan that works for me. Like, there's no one size fits all here. Like, you can put some generic numbers on this, but it's going to be very individual to the person's unique situation. Okay, so just, there's no such thing as like basically buying a house for cheap. Like, you may realize that you want to buy a $100,000 house, but really the true cost of this whole process is going to be a little bit higher, because you're going to have the cost of the home, and then you're also going to have the cost to actually purchase the home. So there is the settlement part. So there's a lot of different professionals that come into play to make that happen. So we have some lawyers that come in, we have the loan officers, there's a title company, so they make sure that the house is actually in your own name. You have things like inspectors that might come and see the house if you choose to have that happen. So be prepared for when you go to buy a house that the price you're seeing on something like Zillow is not actually the total price of what you're going to need in order to be able to purchase that home. So just be aware of that. All right, so let's kind of get out of the weeds for a little bit. Let's talk something a little bit easier. A mortgage. It's a type of loan. It's an installment loan. So we're going to have a fixed term. Usually in mortgages, it's 15 or 30 years, right? You can break it down to be what you want. You can customize it. 10, 15, 20, 25, or 30. Cool. And then, so that's the term, the length of the loan. We have the interest rate and we have the principal amount. So those are kind of the parts you're borrowing. Yep. So we should all be pretty comfortable at this point with what principal is, the amount borrowed, the interest rate is, the interest you're going to pay on the loan. And then that's going to make up part of the actual mortgage payment. So the part that I see go out of my bank account every month, that's not all going to the loan officer per se. What else goes into like a mortgage payment? So when I'm budgeting for a housing cost, what else do I have to put into that? So what you just described is principal and interest.
Yeah.
That's the loan payment, right? You have your interest at 3.5%, and your loan is $100,000, and your payments are made, and you have principal and interest payments. Us in the mortgage world, we have principal, interest, taxes, and insurance. We call it a PITI payment. Principal, interest, property taxes, T, taxes, and I again for homeowners insurance. So all four of those are wrapped into your payment because you have escrows, right? So your property taxes on your home, let's say, is $2,000 a year. And on a $100,000 house, that's really high. So it'd probably be cheaper than that. But this is just examples. We're just playing with numbers.
Frederick's in the taxes, man.
Yeah, right, exactly. So that $2,000 is broken down and into 12 payments, right? And that's part of your mortgage payment. Now, when you go to settlement, you're going to pay a little bit more or less depending on when it's due or where you are in the year, because it's always due on the same day. Property taxes is due in July and December, and you pay for 6 months at a time. Unless you have it set up differently, you want to pay it annually, then it's always paid in July, right? And if you go to buy a house in January, then you've got to make sure that January, so you skip February, your first payment is March, April, May, June, 4 months will be paid in from your monthly payments. You need 2-month cushion, and you need 2 months to make 6 months, so you just paid 8 months of taxes to get started.
And just kind of
PITI.
Yeah, and just to kind of break that down, so you're going, like the mortgage company is basically doing a kind of a nice service here. They are saying, all right, we're going to, in this little mortgage payment, not so little, but in this mortgage payment that you're going to send in, you will have the payment for the principal, so that's the part you actually borrowed, the interest, so basically the cost of that loan, and then the insurance, so the homeowner's insurance, we're going to take that, we're going to hold it for you in this escrow account. It's a special type of account where money is stored to be paid for a certain purpose. So basically, the mortgage company is just holding the money for you, and then when your insurance payment is due, they are paying it on your behalf. And same thing with your taxes. So they are collecting your taxes for you on a monthly basis to be distributed in July and January? December. Yep. Got it. So yeah, it's a nice service. Can you opt out of that? Can you just say, you know what, I want to take care of my own taxes and my own insurance?
Question. It's a very good question. It's part of risk-based, right? They want you to do it because it's less risk to them. Mm-hmm. They're in control. So therefore, you can opt out of it, but not unless you put at least 10% down.
Okay, good to know.
And then you have to go conventional. FHA won't allow you to do it. VA or USDA will not allow you not to escrow. Only conventional, and only if you put 10% or more down.
Okay, good
and it costs a little bit.
Yeah.
Because it's risk. The risk is this. If you don't pay your taxes, and the sheriff comes in and to put your house up for sale, they call it tax sale, right? So now the mortgage company is going to lose your $100,000 mortgage because you owe $2,000 in taxes. Then the mortgage company has to pay an attorney to go to the courthouse and buy it back for $2,000 so that they can control the $100,000 mortgage they have. Otherwise, if somebody buys it, then it's a real legal quagmire. So that's why they like escrowing.
Simplification and lowers the risk to the borrower. Nice and okay, that's straightforward. All right. It's like, okay, that was an easier topic to get our head around. I like that one. All right, so let's go dip back to credit score for a second. When you talk about providing a loan, what impact does a credit score have on the cost of the loan to a borrower? So like say, what's the difference between me having a 640 and an 810 credit score? What's that going to do to my mortgage payment?
It's big. It's huge. Mm-hmm. I don't know how well these guys or how whoever's listening to this is versed in credit. So we can talk about that sometime. But the difference between you don't want to do a conventional loan if you're under 680, right?
Okay.
So you want to really be over 680, and it all depends on how much you're putting down. Everything is risk-based on conventional loans. So if you have a 680 credit score and you're putting down 5%, then you're going to have a rough rougher interest rate. You're going to have rougher mortgage insurance. It's going to be more expensive to you versus a 680 on FHA. You have a much lower interest rate. You have the one size fits all mortgage insurance, but I mean, to put it into a dollar different is hard because it's all percentage of where you are. But the higher, so as an example, I've been doing a lot of rate term refinances where we can get into that in a minute. But let's say somebody has they're two clients, they're both in FHA, and one has credit score of a 680 and the other has a credit score of 750. The one with the 680 can do a rate term refinance and get their interest rate right around 3.5%, maybe 3.6. The other one is getting 3.2, maybe 3.1 today, all in the same loan, if that helps put it into perspective.
So a little bit of difference in interest rate.
Oh, yeah.
And I was going to say,
monthly payment isn't just the only benefit, because remember that interest rate carries through for 20 years, 30 years, 240 payments or 360 payments. So you're talking about $100 savings turns into tens of thousands of savings in the end.
Yeah, I mean, I looked up a quick example before we got on, and is if you add a $160,000 loan, a difference in 1% in the interest rate could be about $100 per month on your mortgage payment. And then over the life of the loan, you're talking about nearly around $30,000 more that you could pay for your property, for your house, compared to if you had a better credit score.
Oh, so, yeah.
Especially for our audience, high school students, seniors, like that idea of building a solid, credit foundation, credit history, doing it responsibly, like that is going to be so important for you moving forward when it comes to buying a house. Because I can't imagine many people will go in, first house, 100% cash down. I'm going to put $200,000 down to buy this house. It doesn't happen very much. Most people are probably mortgaging their first house. So they're getting a loan to help them buy it. And it's going to make a huge difference to the monthly payment. So the amount of cash flow you're going to have each month, as well as the overall amount you're going to spend on this property. And remember, $100 a month, if you start investing that instead of paying down a mortgage, you're going to make dramatic differences on your net worth.
Oh, yeah. I mean, if you get nothing else from this conversation, this interview, set yourself up with good credit. That's number one. Set yourself up with good credit. When someone offers you a credit card and you're straight out of high school or early in high school, get one and start using it, right? To get your best score based on credit card usage, you want to keep your balance no more than 30% of the total limit. So if somebody gives you a $300 credit card, you never, ever, ever go over $100. Never. Yeah. And you just leave it there and you make your payments, and that's going to build your credit score. Lots of things go into credit scores, but by far the most important is making your payments on time and regular.
I'll give you a fun stat. The people with the highest credit scores in the US, their average credit utilization is under 6%. So the people who are the best at managing their credit are putting stuff on, say, a credit card, but they are paying it off every single month. They're not letting it build up. They're not letting it kind of spill over. They're not doing minimum payments. This video should hopefully be coming after our credit card video. So you should know a little bit about credit cards at this point and the potential danger they have, but they can be a very big tool in your toolbox of personal finance. So definitely be thinking about, okay, how do I get this credit score to a nice position where if I do want to get a bigger loan, it's going to cost me less money. So if things cost you less, it leaves you more room to go invest or grow your net worth and just make life a little bit easier. We talk about the current environment that we're in, this COVID-19 situation. If you have a high mortgage, a high car payment, that could have been lower with a better credit score. It could be the difference between you having plenty of food on the table this month versus having a really tight budget this month. So it may seem easy, to pay it when things are good, the paycheck's coming in, it's enough to cover everything, I can afford it. But really thinking about all right, what should it be in my budget? Am I saving? Am I building an emergency fund? All that sort of stuff.
Yeah, for sure.
Yeah. So when we're thinking about, now this is again a hard question. I want to buy a house, but I want to make sure my mortgage fits in my budget. So we're kind of reverse engineering this. We're saying, okay, from a monthly payment perspective, I don't really want to just be able to afford it. I want to keep my total cost of housing under, say, 30% of my budget, my net income.
Yep.
So I pick a number out of my head, say, okay, I need my mortgage to be $1,500 or less.
Yep.
So, that would imply you're bringing in about, maybe $6,000 a month. Maybe your entire household is doing that.
The way I always work on that is I always do it the other way. So somebody comes to me, they make $4,500 a month. You times that by 30%, then you don't want a mortgage payment more than $1,350.
Yeah.
Right. That's exactly how I work that. So you're right. If you're $1,500 a month, then you're right around $6,000. On mortgage approval, the guidelines are 29 and 41 is what the guidelines are. Now there's exceptions and movement in that, but 29%, what the federal government says is that you really don't want your mortgage to be more than 29% of your gross monthly income, right? And then the second ratio, the 41, is your total debt. So you don't want your total debt, house payment, car payment, credit card payments, all that stuff to be more than 41% of your gross income. Now, I have programs that go up to 50%.
And this is important to note, guys. Like, same thing with credit cards. Like, it's not that people are out here to get you, but you have to be educated yourself when you go to get a loan that you will be offered potentially more loan than you can necessarily afford, or you can maybe afford it, but it could take up a huge amount of your budget. Like, talk about half your paycheck going to your house every single month. You are house poor. Too much of your money is going into your house. So it's going to be up to you to be that responsible person who has educated themselves about, okay, how much house can I actually afford to stay within my budget that is a responsible budget? So you can't say like the lender is going to, do my homework for me and say, okay, what? No, you can't buy that much house because you need to stay down in this spot. They're gonna say, okay, what do you want to buy? Let me see if I can make that happen for you. So it's up to the buyer. You got to be responsible.
I do my best to talk it over, but what really pushes people is I say, all right, you're qualified for $250,000, and then you go out there and you find $250,000 house, and you're like, well, dang, man, I want a pool and I want this and I don't want to have to paint it. So now you're like, hey, I found this really good house. It's $300,000. I go back to the numbers. I'm like, yeah, I can get you a mortgage for that, but it's going to cost you this and it's going to cost you that. And then you go, that's where you got to use your brain and figure out, all right, that means I'm going to have to spend less here and less here and less here or more here or whatever and figure it out. Yeah.
At the end of the day,
I'll have that conversation with everyone.
Yep. Your mortgage provider is not your financial advisor. They're not your mother. Like, they are there to make it what you want happen. With, of course, like a risk profile, like consider, like, you obviously don't want to loan out too much money that someone is just not going to be able to repay this. Like, that would just be bad for everybody.
Yeah.
But like, there's going to be like a guideline for what you're going to stay under. And that's not always the best for the buyer, but the buyer at the end of the day is the one making that decision. So you got to be a responsible person.
Yeah, absolutely.
So, what I would recommend to students is like go into something like a bankrate.com mortgage calculator and say, okay, start playing with numbers, like put in a $300,000 house, like, approximately, like, this is kind of that one size fits all sort of calculator, but what would the monthly payments look like on a house like that, including things like tax, insurance, if you have to do the private mortgage insurance as well, and see, okay, now let's figure out, okay, what is the actual price range I should be looking at? And you don't even look at houses that are more expensive than that.
Right.
Yeah. You fall in love with a house that's $20,000 more than you can afford. You'll start thinking, oh, what's the difference between 280 and 260? Like, it's not that much. It's an extra, $30, $40, $50 a month in my payment. Like, you're like, oh, I can make that happen. It's a bad trap. It's a big trap, guys.
Every 10,000 is $50 a month.
every 10,000 on the purchase price is about $50 a month. Okay, Good to know. There's a little rule of thumb to work with.
Yep.
Okay, let's see. Gabe, do you have any, I like what we've talked about so far, good bit of detail with simplification in there too. Is there any advice that you would have for students? So I know we've talked about building credit score. Anything else you would say, like, okay, you're thinking about buying your first home. What else should they be thinking about?
So whenever we qualify you for a mortgage, we're not thinking about your water bill, your electric bill, your gas bill, any of that stuff. your cable bill, your Netflix bill, none of that. We don't take any of that into account. So when you're actually looking to be on your own and you're trying to put together a budget, put it together for real. Don't just be like, hey, my mortgage payment's here and I spend some money on food and I do a little bit of going out. You got to do it for real. Like, all right, you can ask the real estate agent to find out how much the electric bill's been from the people that lived there before so that you can get an idea. Now, they might have been a family of 4 and you're just the 2 of you, so maybe it'll be less. But, I mean, get an idea so that you know. I mean, it's no fun being nitpicky about these things, but you'll be happier in the long run knowing exactly what you're getting yourself into.
Yeah, it's that total cost of housing idea. Like, your house is more than just your mortgage payment. There is maintenance that's involved. Is there a HOA fee? So that homeowners association that we see sometimes.
That's true.
Yeah, that's a fee that you pay sometimes on a monthly basis, sometimes on an annual basis, that goes into kind of a community organization that basically they take charge of like the common green areas. If you have a community pool, they try and make sure that all the houses in the area stay up to a certain standard so that no one's house value is dropping. And that costs money. Like my HOA fee is like $600 a year.
Mm-hmm.
Yeah. So like
$100 a month.
Yeah. we budget like 50 every month to pay for it. So it's something you got to think about. How often does a roof get fixed? About every 10 years, you got to think about putting a new roof on a house. You got water heaters.
That's quick.
Yeah.
Usually the 30.
Yeah.
30 years for a roof.
Okay, good. That's better.
If you're real fancy and you spring for the expensive shingles, you can get a 40-year shingle.
Good to know. All right. So I know like we moved into our house and within, I'd say the first 4 months, we replaced the water heater. So like those things have a fixed lifespan as well. And we could tell that ours was on the way out. We knew it when we were buying the house. So that was something that our inspection turned up.
Yep.
So this is the person who comes, looks at the house, kind of kicks the tires on it a little bit, says, all right, these are the things that are good about it. These are the things that will probably need to be fixed. Make sure you know that before you go in and buy this house. And so we knew we were going to have $1,000 outlay, almost as soon as we bought the house. So we made sure that was included in our budget, because the last thing you want to do is blow all your money on this house and then suddenly something needs to be fixed and you got nothing left.
Nothing.
So your emergency fund is not a house down payment, guys. That does not get touched. That is something that is for emergencies only. You're going to have to save for your down payment separately. Do your total cost of housing analysis. So make sure you're thinking about all the things that go into your house. Gabe mentioned your utilities, anything extra subscriptions wise. So like Netflix, it may not be a housing calculation, but certainly throw it in there. Like that's part of your budget. That's something you have to account for every single month. You know it's coming. Make sure you're thinking about it. Are you going to pay somebody to mow the lawn? Or are you going to do it yourself? If you're going to do it yourself, do you have a lawnmower? Are you going to buy one? Or are you going to pay for a service to come in and do it? Like how much is that going to cost you every month? There's a lot of stuff here, guys. A lot of stuff.
Comcast.
Oh yes, especially if your internet provider has a monopoly in your area. Be expecting a nice fee for that one.
Oh yeah.
All right, Gabe. Thank you so much. How can people get in contact with you if they have any questions?
Anybody has any questions? Parents have any questions? You can reach me on my cell phone anytime. 240-344-7403. You can email me at gfortmann, that's GFORTMANN at embracehomeloans.com. I'm pretty sure if you Google Gabe Fortmann, you'll be able to find me.
Assuming you're in the Frederick area. I don't know if that Google search would hit across the country, but certainly, it can be done.
Yeah, definitely in the Frederick area. Because that's one thing you get as a local lender, so that you can sit down or that you can have those conversations. We're talking about the exact same things. If you talk to an internet lender, they may not know your area at all, and you don't talk to the same person twice. So there's also a difference. But you asked how to get in touch with me, not all that.
I mean, that's a nice piece of parting advice, guys. Getting face-to-face with somebody, ideally somebody who knows the area. It's nice to have those conversations in person. So be thinking about that. Maybe going with a local lender versus a big bank or an online lender.
Yep.
All right. Good words of wisdom. Thank you so much, Gabe.
Yeah, absolutely. I hope everybody finds it useful and stay safe. And, we'll get through this.
True that.
Cool.